When the Fed starts panic cutting, then silver will outperform gold dramatically. So yeah, you got to own silver. The price of gold in the second quarter of this year was about 17% higher than it was in the second quarter of 2023. So that gave the big gold miners a nice pop in revenues. A lot of that fell down to the bottom line. So it was either free cash flow or net earnings that went way, or both that went way up. And the junior mining space will be a very exciting place to be. So, again, here's hoping that would be very cool because
Yeah.
I own a lot of beaten up junior miners, that
Yeah.
would be
Same.
nice to see them just to get back to where I paid for them. But another 65% or 100% or whatever on top of that would still feel good in the short run.
Leading financial analyst John Rubino notes that during the second quarter of this year, gold prices rose more than 17% compared to the same quarter in 2023, greatly benefiting the leading gold mining companies. According to John Rubino, rising gold prices are boosting the revenues and profits of major gold miners, but also driving them towards expansion through strategic acquisitions. The recent sharp decline in the stock market pulled gold stocks lower. GDX declined 14%, and GDXJ declined 18% in only 3 weeks. However, they have started to recover as gold is now trying to pull away from its correction, which turned into a bullish consolidation. There is still plenty of value and upside potential in high-quality juniors. Before the sharp correction, the miners and juniors had made good progress against gold. They have outperformed gold since the yellow metal began its breakout move in February. Historically, they reliably outperform after breakouts in gold. Regarding potential Fed panic cuts bringing interest rates near zero, Rubino predicts silver will significantly outperform gold, making it crucial to own. Bank of America believes silver will likely outperform gold due to its greater sensitivity to manufacturing activity. While reflecting on elections, Rubino expects favorable but potentially misleading economic numbers that could justify interest rate cuts and lower the Fed funds rate. However, after the election, he predicts negative data may lead to a recession in 2025 and drastic rate cuts by the Fed, making investing more challenging. The yellow metal soared to an all-time high on Friday, August 16th, as the US dollar weakened after positive macroeconomic data led Wall Street to raise bets for an upcoming interest rate cut from the US Federal Reserve in September. Now, we present the clips of John Rubino's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Well, that's what you get when the thing you sell goes up in price, right? And that's what happened with gold. The price of gold in the second quarter of this year was about 17% higher than it was in the second quarter of 2023. So that gave the big gold miners a nice pop in revenues. A lot of that fell down to the bottom line. So it was either free cash flow or net earnings that went way, or both that went way up. And what happens then, when big miners are seeing rising free cash flow, they initially help out their shareholders immediately with, dividend increases or share buybacks.
Yeah.
But then that cash flow is still coming. And so they start looking around and thinking, wow, I could build an empire. I could be bigger than this guy who I'm smaller than him now, but let me make just a couple of acquisitions and I'll be the one not taking his calls, and so they start empire building and like you said, legitimately rebuilding their resource bases, and they do that by buying up the really good quality explorers and junior producers who are big enough to move the needle for a big company. And Osisco, that, as you mentioned, was bought out by Anglo Gold for a really nice premium, 60-some% one day to the next in that stock. And it's just a really good quality resource that Osisco has delineated. And that's not a company maker for somebody like Anglo, but it's a really good, they called it a bolt-on acquisition. You just add that to your other reserves,
Yeah.
everything looks great. You don't miss a beat, and so there's a lot of small miners and explorers who aren't producing yet, but who found a lot of gold in the ground, who are, in the conversation of who's next after a Cisco. Once people saw that kind of a premium, then they want to know who hasn't gone up yet, but who is capable of being bought out for that. And there's a bunch. So So let a
Sure.
couple more deals like that happen, and the junior mining space will be a very exciting place to be. So again, here's hoping. That would be very cool because
Yeah.
I own a lot of beaten up junior miners, that
Yeah.
would be
Same.
nice to see them just to get back to where I paid for them. But another 65% or 100% or whatever on top of that would still feel good in the short run. We'll have favorable economic numbers going into the election because we've had them for the last year. What they do with, for instance, the jobs number or whatever, is they report a beautiful number, take credit for it, and then revise it back to its much lower number, real number, over the ensuing months when nobody's paying attention. Um, we shouldn't trust them, other than for the fact that they're going to justify, those numbers will justify cutting interest rates. So there is going to be a real
Right.
world impact here where
So
we'll get
right.
lower interest rates, maybe like 3/4 of a point lower on the Fed funds rate by the time the election happens. And that'll have an impact, although, 3/4 of a point is not going to destroy the world or save the world. But probably, okay, here's the scenario that probably works out is that the economy still looks reasonably good in early November. But after the election, the bad numbers are allowed to come out, and the natural momentum that we have, which is downward, really gets going. And we have a pretty serious recession in 2025, which causes the Fed to panic cut. And then we get back into where we were 3 or 4 years ago when interest rates are close to zero, and inflation has been replaced by deflation as the big fear. We're liable to be back there this time next year. So question is, how are we going to invest for that kind of a sea change? And I'm not really sure because it's not even necessarily that good for gold and silver early in that process. Cutting interest rates is good, but deflation fears are bad. So we'll have to see. This is going to be a tricky one to navigate, but it's going to be very different, which means different things make money for us in early 25 from what has made money in the past 3 or 4 years. So fascinating times, but we'll have a lot to talk about.
From a technical perspective, John Rubino warns that Japan's efforts to prop up the yen by selling off foreign exchange reserves could lead to a catastrophic scenario in which the country faces inflation, a crashing currency, and potential government bankruptcy. This situation, he predicts, could have severe repercussions not only for Japan, but also for the global financial system. The yen rose against the dollar on Friday, but still looked on course for its biggest weekly decline since June after the latest batch of U.S. economic data eased fears of a recession and supported bets of gradual Federal Reserve interest rate cuts. During the recent market disruptions, Rubino warns that financial losses could reach tens of trillions when the full-scale crack-up boom hits, making this potential crisis one of the most significant in history. Let's get back to the interview.
I think it's the culprit this time around. So basically, the carry trade is a few years ago, Japan had incredibly low interest rates, like 0.5%. You could borrow yen at half a percentage point. But the rest of the world had really low interest rates too. But then the US and Europe started raising their interest rates. And that created this really juicy spread where you could, buy yen for 0.5% because Japan did not raise their rates. And then you invest that money in US Treasury bonds for 4.5%, and you make a 4% spread for basically just a couple of mouse clicks.
Risk free.
Yeah, yeah. Well, people thought it was risk-free. But then Japan, by keeping their interest rates so low for so long, started to affect the value of the yen, and it started to plunge. Everybody else had high interest rates. Japan had low interest rates. It made the yen less attractive for certain groups to own. And so the yen started to fall in a disorderly way. Japan had to step in and prop up the yen. And that made, first of all, it made the yen go up versus the dollar, and it made Japanese interest rates go up. So it blew up the carry trade. All of a sudden, you're not paying that loan back in depreciated yen. You're paying it back in appreciated yen. In other words, that loan that you thought you were going to make 4 or 5% on is going to cost you 15 or 20%. And you did it with size. You did $100 million or whatever.
Billions.
If you're a hedge fund, well, in the aggregate, it was $1 trillion or so dollars, some analysts think. So you've got $1 trillion or so worth of carry trades blowing up out there. And that means that people are having to sell their stocks to come up with the margin calls on these things, and that affected all the financial assets out there. And that's what blew up the stock market just lately here, because you saw the Japanese stock market tank first. And then the NASDAQ in the US collapsed, and that pulled the rest of the US stock market down. So it was, I think it's a safe bet that it was the
Oh,
yen carry trade blowing up that caused this problem. But the important thing is there is no fix. If you're Japan, yes, you can bring your currency back up. But to do that, you have to sell all your dollars to buy yen. And then your foreign exchange reserves are drained, and your government is still borrowing insane amounts of money. So then you have inflation, or you have a crash in currency, or you have a bankrupt government. You can't get out of this without a gigantic existential crisis. And that's what people are realizing right now, because, yeah, okay, maybe we stopped the carnage in the stock market, but we actually didn't fix any of the underlying problems
never do.
with the financial system. Yeah, so that's the crack up boom that we've got ahead of us at some point in the not too distant future. And this was like a little mini version of that, but it's going to be much bigger when it happens, because $1 trillion will be a rounding error when the actual crack up boom happens. So it'll be tens or more than that of trillions of dollars of financial assets all blowing up at once. So and that's if we avoid World War III, right?
Yeah.
This comes as no surprise, considering the current macroeconomic backdrop is fueling a perfect storm for gold, firmly positioning the precious metal as one of the best performing asset classes of 2024. Experts forecast silver to move higher in the second half of 2024 because the peak in yields is confirmed. How are you preparing your portfolio to navigate the potential economic upheavals and capitalize on the opportunities presented by the rising significance of precious metals? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video. Eat.